Welcome back to today's analysis, everyone. If you're an institutional investor or professional trader, you already know the CME SOFR futures market is a massive piece of the global financial puzzle. But today, we're not just looking at it as a rigid derivative. Think of the SOFR market as a living, breathing organism. It actually has a very distinct heartbeat. So let's just dive right into it.
Right off the bat, I want to ask you a pretty fundamental question. When is the absolutely best time to trade SOFR futures? We spend so much time obsessing over the macro environment, focusing entirely on what direction to trade. But honestly, in the SOFR market, when you trade is just as crucial, literally just as crucial as what you trade. If you want to minimize slippage and cut those execution costs, timing isn't just a factor, it's the core of defending your returns.
Here's our roadmap for this explainer. We'll start with the heartbeat of the SOFR market, look at global sessions, and then dive into the morning golden hour. After that, we'll cover the cash open, the final opportunity at settlement, and wrap it all up with actionable tips for actually reducing your execution costs. All right, Section 1, the heartbeat of the SOFR market. So SOFR has really evolved from just a LIBOR replacement into the definitive real-time barometer of Fed policy expectations. And looking at this daily volume breakdown, the imbalance in liquidity is pretty staggering. Check this out. Regular trading hours, so that's 7 a.m. to 4 p.m. Central Time, pull in a massive 80 to 85% of the total volume. That's huge. That is when the order books are at their absolute deepest and bid-ask spreads are razor thin. Compare that to the European session at 12 to 15% and the Asian session at a tiny 3 to 5%. So the takeaway here, if you're moving large-scale institutional capital, the optimal window for efficiency is really only wide open during these specific regular hours. Moving on to Section 2, Global Sessions, Opportunities, and Risks. Now, just because the overnight hours are quieter certainly doesn't mean we should ignore them. If we rewind to the late Asian and European trading sessions, we see a real tug-of-war, fast price discovery versus limited market depth. Sure, the Asian session is only 3 to 5% of the volume, but it's the very first line of defense during global interest rate shocks or unexpected overnight central bank news. It absorbs that initial hit. But here's the catch. Because the order books are so thin, price swings get wildly amplified. It's a classic double-edged sword, making your execution risk exceptionally high during these hours. Okay, let's ramp things up. Section 3, the golden hour, morning liquidity concentration. This is where the real action begins, the U.S. morning. If we map out the intraday liquidity clock, we hit these critical nodes between 7 a.m. and 2 p.m. Central. It all kicks off right at 7 a.m. Central with the New York Fed's official SOFR fixing. This is a big deal because it completely wipes out any uncertainty around the previous day's funding conditions. It acts like a starting gun, drawing OIS SOFR basis traders and cash futures arbitrageurs straight into the action. And then, we hit it. 7:30 a.m. Central Time. This is the market's true golden hour. Why? Because this is exactly when the heavy-hitting macroeconomic data drops, things like Nonfarm Payrolls and CPI. The second that data hits the wire, it either shatters or completely solidifies what everyone assumes about the Fed's inflation outlook. Suddenly, you got asset managers, macro hedge funds, and bank rate desks absolutely scrambling to recalibrate their bets. We see a massive influx of directional and hedging orders flood the system. Liquidity and volatility basically explode at the same time. Hands down, it is the most hyperactive trading interval of the entire day. Next up, Section 4, cash open and market integration. So after the 7:30 storm passes, we hit 8:30 a.m. Central, the official open for U.S. cash equity and treasury markets. This is driven by portfolio rebalancing, duration targeting, curve risk adjustments, and basis convergence trades. The real magic of 8:30 is that it completely transforms SOFR futures from a standalone product into something so much bigger. As equities, treasuries, and FX markets all boot up together, SOFR futures become this central gear, interacting seamlessly with cross-asset flows across the entire U.S. rates ecosystem. And, as you might guess, that creates another massive, undeniable surge in liquidity. Let's fast forward into the afternoon. Section 5, the final opportunity at settlement. Now we're looking at that crucial 30-minute window right before the CME's daily settlement at 2 p.m. Central. What's driving the action here?
It's all about end-of-day risk reduction, benchmark alignment, and systematic portfolio rebalancing. If you're an institutional investor or running a derivatives desk, this is your daily off-ramp. It is basically your last major chance to offload significant risk into incredibly deep, stable liquidity before the bell rings. And because of that, it's the absolute focal point for volume in the afternoon session.
All right, let's get practical. Section 6, Tips for Reducing Execution Costs. We've mapped out the liquidity clock, but let's actually apply this to your execution strategy, because at the end of the day, that's what protects your bottom line. Minimizing slippage is the name of the game here. If you need to move massive institutional-sized blocks without leaving a huge footprint, your optimal execution windows narrow down to exactly 2 prime spots. First, right after those 7:30 a.m. central macro releases, and second, that tight window just ahead of the 2 p.m. central daily settlement. During these specific bursts, order book depth reaches its absolute peak for the day. Literally, just aligning your trades with these 2 liquidity apexes can save you immense amounts of capital and execution costs. It's that simple, but it's incredibly effective.
I think this quote perfectly sums up what we've been talking about today. CME SOFR futures have evolved far beyond a simple short-term interest rate derivative. They now function as one of the most important real-time barometers of Federal Reserve policy expectations. It's so true. From macro data drops and benchmark fixings to the cash open and afternoon settlement, understanding this rhythmic flow of liquidity is absolutely essential to surviving and thriving in this market. To wrap up this explainer, I want to leave you with one final question to chew on. Does your trade timing actually align with the market's liquidity clock? Think about it. You could have the most brilliant market insights in the world, but if you're throwing massive orders into thin, shallow order books, you are paying unnecessary costs. I really encourage you to take a hard look at your own execution strategies and see how you can sync them up with this liquidity clock. Thanks so much for joining me, and I'll catch you in the next analysis.